Our speaker today is Kimberly Lewis Robinson, and she is the Secretary of the Department of Revenue for Governor John Bel Edwards. And prior to her current position, she served as partner in the Tax and Estate Practice Group at Jones Walker. And there she primarily practiced state and local tax matters, including tax and business planning, tax incentives, appeals, audits, tax litigation and appeal, tax controversies, and state and local tax statutes. So she knows her taxes. Her practice also includes the area of economic development financing, incentives, and government relations. And before joining Jones Walker, she served as special counsel for the Office of the Governor, where she worked as legal counsel for Kathleen Blanco. And during her tenure with the governor, she served as liaison to the Department of Revenue and Economic Development, and served as senior policy advisor on economic development, insurance, and revenue policy. She also worked for 6 years at the Department of Revenue, serving as Assistant Secretary for the Office of Legal Affairs and confidential assistant to the Secretary. And from 1998 to 2000, she served as a judicial clerk to the Honorable Justice Burnett Johnson, who is now the Chief Justice of the Louisiana Supreme Court. So, welcome, Kimberly Robinson.
Thank you very much, and thank you for having me here at the Press Club. I always wanted to be a speaker at the Press Club. Okay, maybe not. Maybe not. But definitely if I was going to speak on something far more exciting than tax reform. But in reality, is there anything more exciting than tax reform in the state right now? I mean, it is a constant discussion. I have been invited to speak and talk about this. I co-chaired a task force that talked about nothing but this. I sit on 3 other commissions and task force that are focused on tax issues. So tax is clearly the hot topic. It is the way to go. And for once, being a tax girl is cool. So I wanted to spend a little time today talking about the House Concurrent Resolution 11 Task Force. This is the task force on structural budget reform and tax policy. And Robert Travis Scott aptly named this the task force or the committee on the theory of everything. So when we started our work in March of this year, we were focused on both the state's fiscal condition and tax reform as it was laid out before us. We worked with certain guiding principles. One, that any revenue system needs to be fair, it needs to be simple, and it needs to be competitive with other states. Lastly, and most importantly in today's environment, it needs to be stable over the long run. When I talk about fairness and simplicity, one, we want every taxpayer to believe that they're being treated fairly. We don't want anyone to feel that they're being singled out. We don't want a particular group to feel that they're paying more taxes than other people. From a simplicity standpoint, we want it to be easy to understand so that voluntary compliance remains high, and we also want it to be simple to administer from a tax administrator's perspective. Economically competitive with other states. We don't want to be the odd man out. We want to make sure that we continue to grow our economy, attract new business, and keep existing businesses here. And stable over the long run, meaning stability is very important. We cannot have a tax system that does not produce sufficient revenues to fund state services. With those principles in mind, we set about developing a tax structure that is both broad-based and has low rates. The broader the base, the more fair the system is perceived to be, everyone is paying, and the lower the rates, the more progressive in nature and less regressive in nature that tax system is. When we started our work, we looked at both spending recommendations and revenue enhancements. From a spending side, we wanted to make sure that the state focused its attention on dedications. Louisiana has more than 500 dedications in number. That's both constitutional and statutory. And it's very important that the current legislature look at those dedications, as well as the division and the governor, and make a determination whether all of those are still spending priorities for the state. Things that may have been dedicated in 1978 may not be as much a priority as when it was dedicated in 1978. We may have grown beyond that. We may not even have that industry or that need anymore. So we are recommending that the legislature take a serious look at the dedications with an eye towards those things that can be eliminated, but recognizing that eliminating dedications does not in and of itself free up money in the budget. A lot of those dedications are to areas that someone has found to be important. Some of them are fees for service. Those fees and those services will continue to need to be performed. They don't just go away because you eliminate the statutory dedication to it. Some of those dedications, like the minimum foundation program, which is by far one of the largest in the Constitution, well, that funds K through 12 education. We're not going to walk away from funding K through 12 education, so eliminating that in the Constitution would not have the same effect. The same with the Transportation Trust Fund, which we also know that we need infrastructure very badly in this state, and that's another task force that has been meeting and will be issuing their report in January on transportation infrastructure funding. In order to make this process easier, we're recommending staggered sunsets on some of these dedications so that they do come up for review on a regular basis. And once you review them once, you don't just leave them there and forget about them. We want to make sure that spending is focused on areas that we have identified, but that we're spending recurring revenue on recurring expenditures, and that we're leaving the non-recurring revenue to those areas that are set forth in the Constitution. When your recurring and non-recurring revenue get out of whack, you end up with mid-year deficits, and you end up with the necessary budget cuts that we've been living through for the last 9 years now. We also are recommending that we not focus on short-term revenue gains that will have long-term consequences. One of the most important being the UAL, or unfunded accrued liability. Now, we could refinance that debt and stretch it out further, but it's going to cost us more money. We are currently on the path to pay down that UAL, and that is something that we need to continue doing in the way that we're doing it. And we also need to focus on ensuring that we don't create any future unfunded accrued liabilities. Recognizing that the state has focused its efforts on streamlining and efficiencies, we recommend that that continue, that not only have we had recommendations from prior years, 2010 and 2014, but in 2016, the legislature enacted House Concurrent Resolution 25 and asked all agencies to identify ways that they could further improve their efficiencies. We think that's a good exercise, and it should continue. We also are mindful that this is not a silver bullet. There's not an efficiency that can be created that will automatically help us with a $300 million or $600 million deficit. It is efficiencies that over time will cause savings, but they are not immediate savings to the state fisc. Now on to the revenue side. What we recommended is based upon our existing structure. In 2016, when we made changes to the sales tax, we made the state very reliant on sales tax revenues. So from a just overall budget perspective, the sales tax revenues are projected to be 36% of our total spending, whereas the next closest category is income tax or individual income tax, which is predicted to be 25%. The task force is recommending that those two major components of spending be equalized so that you're closer to having 33% from sales tax, 33% from individual income tax, and the remaining third of the budget coming from other areas, including the excise taxes, the severance taxes, mineral revenues, and the premium taxes. So one, in doing so, you balance out your reliance on one revenue source versus the other. Most people that tell you anything about an overall tax structure is to have a balance or three legs to your revenue stool so that you're not with one leg that's far greater than anything else and your stool is never balanced. So 3 legs is what we're recommending: income, sales, and the other leg made up of the miscellaneous taxes. The other piece of that is that if you have income tax and sales tax both equal, they balance out the regressive nature of the sales tax, and they make the income tax, which is a more progressive tax, spread farther across the border for both individuals who are at the lower end of the economic spectrum as well as the high end. From an income tax specific recommendation, we are looking at the federal income tax deduction. Now, this was the same deduction that was up for corporate income tax on the November 8th ballot, and we heard from the voters that they were not in favor of removing that deduction. But we also recognize that most voters didn't get any information beyond the reports that were put out by maybe PAR and cable explaining the amendments. We need to do a better job of educating the public on what the federal income tax deduction is, the impact it has on state tax collections, as well as the impact it has on their state tax payment. If your federal income tax decreases, you're going to pay more in state tax because you have a smaller deduction. So we need to explain that, and we also need to explain that by eliminating that major deduction, you are making the base so much broader that you are in the position to lower rates. And that is the other side of our recommendation, to lower our current 2%, 4%, and 6% rates by 25%. And then with those changes, we will still generate the revenue necessary to fund state government, but everyone will get to enjoy a tax break of some sort. In the event that the federal income tax deduction does not come up for a vote by the voters again, what we are recommending is further changes to the income tax, but on the excess itemized deduction side, and a compression of the brackets. This sounds like what we had in place prior to changes that were made in 2007 and 2008, with the excess itemized deductions going away and the brackets being compressed. We think this is a good exchange or trade-off in the event federal income tax deductibility stays in the Constitution. Other changes that we're recommending include establishing sunset dates for certain tax credits, deductions, and exemptions on the income tax side, but also continuing our investment in some of the exemptions and credits that spur early childhood development. Those were enacted in 2005, 6, and 7, and we think those are good programs that we should continue to invest in. On the sales tax side, we are recommending broadening the sales tax base by eliminating certain exemptions, specifically those exemptions that were eliminated from the clean penny when it was enacted during the first special session. We're also recommending doing away with that clean penny. We need to go back to a 4% rate as opposed to the current 5% rate. Louisiana's sales tax rate is at this point, when you look at certain local governments, we have the highest sales tax in the country. That's not good for our citizens, nor is it good from an economic development standpoint. So we need to be able to move back to the 4% rate. We also need to expand our sales tax base to tax services. That is the fastest growing sector of our economy, and we need to look at our sales tax laws, which were for the most part enacted in the 1940s, catching up with today's economy and taxing the way that people consume things and the way that businesses do business. When I was a child, we went to the library or we went to the bookstore to buy books. We didn't go on our laptops or our phones or our iPads to buy books. We actually had to go somewhere physically, pick up an item. It didn't get delivered electronically in just a matter of seconds. I remember the first Kindle I received as a gift, it told me it had whisper technology, and I was thinking, well, what does that do? And so I went to the bookstore, I found a book I wanted, and within 10 seconds, that book was on my Kindle, and I was like, whoa, this whisper technology is impressive. But our sales tax laws don't necessarily recognize whisper technology. They're still looking at something tangible that you receive. So we need to move our sales tax laws into the 21st century, and that's one of the recommendations of the task force. Beyond reducing the sales tax from 5 to 4%, I think that is the most important recommendation that we're making The other things in terms of the services, there's a list of those services available on the task force website, which is maintained by the Department of Revenue. So you can look at those services and get a sense of which services we're expanding to. I often get questions from my fellow lawyers and the CPAs about whether we're taxing them, but I assure them that taxing professional services is not where we're headed, but we are looking at taxing the other services that people consume on a daily basis. The other part of our sales tax that is very important is the issue of uniformity. Right now, there are 3 different bills or proposals pending in Congress. I don't think any of them will get moved before this Congress adjourns, but we expect that in the new Congress, they'll be introduced again. These all stem from what we call the Marketplace Fairness Act. When you buy online from Amazon or Overstock, they have not been collecting sales tax for most of the states that they're in. But if you go to a bricks and mortar store, you're going to pay sales tax. That Marketplace Fairness Act has been introduced over the last several Congresses, but we're finally making progress towards marketplace fairness becoming a reality. For Louisiana, it won't matter unless we do something about uniform administration and a uniform base. So that's the other key to the task force recommendations. Uniformity. The same things need to be taxable at the state and local level. Right now, to figure out if something is taxed at the state level and the local level, some businesses maintain a spreadsheet just so they know when they buy this particular item if they should have paid sales tax or accrued use tax, and whether it was the same in every parish or in certain parishes. It shouldn't be that complicated for taxpayers to comply with the system. The other thing that's required by the Marketplace Fairness Act is a single collector. Louisiana is far from a single collector state. We have the state and we have 62 local collectors. And yeah, I know there are 64 parishes, but Cameron doesn't have a sales tax. So while there are multiple issues from that front, one of the recommendations from the task force is to develop a model that allows for uniformity of administration, uniformity of collection, so that in the event the Marketplace Fairness Act does pass, that we are ready to take advantage of that provision and collect sales tax from online vendors. There's also another commission that's been focused on this issue. It's the Sales Tax Streamlining and Modernization Commission. It's chaired by Representative Julie Stokes. They have actually gone through every exemption in the sales tax laws, and they've been going through all the administrative provisions in hopes of having a draft bill that will be introduced during the regular session that will include all of the provisions that we're talking about. The last thing I want to talk about before taking questions is the corporate income tax and then property tax. On the corporate side, the task force, of course, endorsed the constitutional amendment that was before the voters on November 8th. And I expect that when our updated report comes out, you'll see another recommendation to continue moving towards the elimination of the federal income tax deduction on the corporate side. We're also recommending a phase-out, repeal, or revamping of the corporate franchise tax. We think those are critical to ensuring that Louisiana remains a great place to do business. The property tax is a tax that is collected by local government, but it has become the subject of much discussion at the state level in recent years because of the inventory tax credit. Businesses pay tax on inventory at the local level, and the state gives them 100% credit when they file their income tax return. The current projections are for that credit to cost the state $500 million in FY17. That is a significant portion of the budget, and we need to come up with a way to eliminate that tax credit at the state level, and for businesses to come up with an alternative to the inventory tax. There are other states that impose inventory taxes, primarily in the Southeast, but nationally, inventory is not something that is taxed. There is a belief that it is a tax on a tax, because ultimately that inventory is going to get sold to a consumer or going to become a part of a final product that's sold to a consumer. So the task force has a recommendation to phase out the inventory tax over 10 years and to phase out that inventory tax credit over a 5-year period. We've heard feedback that the 10 years and the 5 years are too far apart. We need to combine those to get to a shorter period of time. But what will happen with that remains to be seen, but that is our recommendation. The inventory tax should be changed. In addition, the industrial tax exemption program that has been the subject of recent changes by Governor Edwards' executive order, we're recommending that those changes be put in the Constitution to allow local approval of the industrial tax exemption and to set standards for how those industrial tax exemption program contracts get approved. I think that covers the majority of our recommendations.